I was watching the Asian markets when the kill switch activated, the moment that would expose just how completely the banking establishment had lost control of forces they had manipulated successfully for decades. Friday, December 12th, 2025, 2:47 a.m. London time, the exact moment when the global financial elite fired their most dangerous weapon in a desperate last-ditch attempt to regain control of silver markets that had slipped beyond their influence like water through increasingly desperate fingers. The CME Group's emergency notice flashed across my Bloomberg terminal in clinical, bureaucratic language that barely concealed the panic behind its measured tone. Effective immediately, maintenance margin requirements for silver futures contracts are increased by 84% to ensure market stability and protect market participants from excessive volatility and potential losses. The sterile corporate speak couldn't disguise what this really was: a declaration of war against anyone who dared to bet against the banking cartel's short positions. 84%. In a single administrative keystroke executed while American markets slept, they had made it nearly 4 times more expensive to hold a leveraged silver position than it had been when traders went to sleep just 6 hours earlier. This wasn't market regulation designed to protect investors. This was financial warfare disguised as prudential oversight, a regulatory nuclear weapon aimed directly at anyone who had the audacity to profit from silver's rise, while the banks hemorrhaged billions on their short positions. They were pulling the same playbook that had crushed silver rallies in 1980 and 2011, the nuclear option that had never failed to trigger massive liquidation cascades and send prices crashing back to levels that suited their short positions. But as I monitored the immediate market response, something unprecedented was happening. Instead of the violent price collapse that should have followed such drastic margin increases, silver was holding. The futures market opened with a brief dip to 63.80, found buyers immediately, and began climbing back toward Thursday's close at 64.25. This wasn't supposed to happen. The margin nuclear weapon was supposed to trigger automatic selling as over-leveraged speculators got margin calls they couldn't meet. I had lived through enough market cycles to understand the devastating power of emergency margin hikes, having watched this exact playbook destroy countless rallies across multiple decades of precious metals trading. In May 2011, I sat at my desk in stunned silence as the CME systematically executed what could only be described as financial carpet bombing, raising silver margins 5 times in 9 consecutive trading days from $4,500 to $21,600 per contract, a crushing 380% increase that obliterated the parabolic rally and sent silver crashing from $49 to $33 in less than 2 weeks. The mechanism was as simple as it was brutal. Force speculators to post dramatically more cash immediately to maintain their positions, or have those positions liquidated automatically by the exchange's merciless computers. When thousands of overleveraged traders couldn't meet the new requirements overnight, most individual investors don't keep hundreds of thousands of dollars sitting in cash for emergency margin calls. Their forced selling overwhelmed all buying interest and created a self-reinforcing downward spiral that turned a healthy correction into a devastating crash. The banks had perfected this strategy over multiple decades of precious metals manipulation, refining it through trial and error until it became an almost infallible weapon for market control. The timing was always the same: wait patiently for retail speculators to drive prices beyond levels that threatened the bank's short positions, then activate the regulatory kill switch overnight when markets were closed and traders couldn't react quickly enough to defend themselves. I had watched them deploy this nuclear option during the 1980 Hunt Brothers crisis, when silver reached $50 and the CFTC suddenly decided that liquidation-only orders were necessary for market stability. I saw it again in 2008, when oil reached $147 per barrel and position limits were suddenly imposed on energy markets. Every time, the pattern was identical: prices rise beyond the comfort zone of establishment short sellers, emergency measures get implemented without warning, and violent selling cascades destroy the rally while enriching those who had bet against it. The kill switch was the ultimate regulatory weapon, a legal mechanism that could destroy any rally regardless of underlying fundamentals, market sentiment, or supply and demand dynamics. It was financial market warfare disguised as consumer protection, a tool that allowed the banking establishment to socialize their losses while privatizing their gains. But something fundamental had changed in the silver market since 2011, something the banks hadn't accounted for when they activated their kill switch. The rally to $64 wasn't driven by leveraged hedge funds and retail speculators chasing momentum. It was driven by industrial users scrambling to secure physical silver for manufacturing operations that couldn't function without it, and by sovereign wealth funds diversifying reserves away from currencies that central banks were devaluing through quantitative easing programs. I started calling contacts across global silver markets to understand why the margin weapon had lost its effectiveness. And the answers revealed a complete transformation in market dynamics that rendered traditional manipulation tools obsolete. Samsung's procurement team wasn't buying silver futures on 20.1 leverage. They were paying cash for immediate delivery of physical metal. The China Investment Corporation wasn't speculating on price moves. They were converting dollar reserves into strategic commodities as a hedge against monetary debasement. The people buying silver today don't use margin, explained Klaus Hoffmann, head of precious metals trading at a major Swiss bank. Tesla doesn't get margin calls. The Norwegian sovereign wealth fund doesn't get liquidated. When you change margin requirements, you only affect the paper speculators, and they're not the ones driving this rally anymore. This fundamental shift in buyer composition had neutralized the bank's most powerful tool for market control. The traditional kill switch worked by targeting the weakest participants, over-leveraged traders who would be forced to sell regardless of their convictions about silver's long-term value. But when the marginal buyers were cash-rich institutions making strategic allocation decisions, margin hikes became irrelevant background noise. The banks were discovering what happens when markets transition from financial speculation to industrial necessity. You can force a hedge fund to sell silver futures when they can't post additional margin. You can't force Samsung to stop buying silver when their battery production depends on it. The physics of industrial demand had overwhelmed the mathematics of financial engineering. By noon European time, it was clear that the margin nuclear weapon had not only failed to crash silver prices, it had backfired spectacularly by exposing the bank's desperation to anyone paying attention. Instead of triggering the usual panic selling, the margin hike was being interpreted by sophisticated investors as a signal that silver supply constraints were becoming acute enough to threaten the financial stability of institutions with large short positions. I realized I was witnessing a historic moment. The first time in modern commodity market history that emergency margin increases had failed to produce the intended price crash. The kill switch had been activated, but the machine it was supposed to shut down had evolved beyond its reach. Silver was operating according to physical market dynamics rather than financial market psychology, and no amount of regulatory manipulation could change the underlying reality of supply deficits and industrial demand. The banks found themselves trapped in a position that decades of successful market manipulation had never prepared them for. Their traditional tools for controlling precious metals prices, margin hikes, coordinated selling, media campaigns about silver being in a bubble, were proving ineffective against buyers who needed the metal for reasons that had nothing to do with financial speculation. Samsung couldn't substitute something else for silver in their solid-state battery technology without abandoning years of research and development. China couldn't print more silver to meet their industrial requirements. Tesla couldn't use leverage to buy silver they needed for manufacturing operations. The fundamental transformation from speculative to strategic demand had rendered the bank's manipulation playbook obsolete. The failure of the margin kill switch triggered a cascade of unintended consequences that made the bank's situation progressively worse throughout the trading session, creating a feedback loop that amplified every aspect of their strategic miscalculation. Instead of scaring away buyers with their obvious desperation, the heavy-handed margin manipulation attracted additional attention from institutional investors who correctly interpreted regulatory interference as confirmation that silver markets were experiencing genuine supply stress that threatened the stability of major financial institutions. Sovereign wealth funds that had been considering silver allocations suddenly accelerated their decision-making, reasoning that if banks were desperate enough to change rules overnight, underlying fundamentals must be stronger than disclosed data suggested. The Norwegian government pension fund quietly instructed their team to expedite precious metals evaluation. Family offices began treating silver like a scarce collectible rather than a financial instrument, bidding aggressively for physical delivery without regard for price fluctuations. The European Central Bank's pension fund added silver to strategic allocation after concluding that traditional monetary assets were insufficient for purchasing power preservation. Meanwhile, the industrial silver shortage that had originally motivated the bank's desperate margin manipulation was accelerating rather than resolving, creating a vicious cycle where regulatory intervention actually worsened the underlying supply constraints that were driving prices higher. First, Solar announced temporary production suspensions at two major manufacturing facilities in Ohio and Malaysia due to critical silver paste supply constraints that made continued operations economically unfeasible at current procurement costs. Apple disclosed in a carefully worded SEC filing that component shortages, including silver-based materials, might materially affect iPhone production schedules for the first quarter of 2026, diplomatic corporate language that industry analysts correctly interpreted as advance warning of potential supply chain catastrophe. The company's procurement team had been unable to secure adequate silver supplies for lightning connectors, internal circuitry, and electromagnetic shielding components despite offering premiums of 40% above spot prices. Samsung's semiconductor division, which produced chips for virtually every major electronics manufacturer globally, warned their largest customers that silver wire bonding material shortages could force production delays across their entire product lineup. The South Korean conglomerate's internal analysis suggested that silver supply constraints were becoming severe enough to threaten their ability to fulfill existing contractual obligations, potentially triggering billions of dollars in penalty payments. The automotive industry was confronting the most severe silver supply crisis in its history. Ford officially delayed their Lightning electric truck launch by 6 months, citing critical materials availability challenges. General Motors warned investors that silver constraints could impact their ability to meet federal EV mandates. Tesla's Gigafactory faced immediate crisis, with production lines scheduled to shut down within 10 days unless they secured emergency silver supplies. Elon Musk personally contacted mining executives, offering to purchase entire annual production at 50% premiums above market rates. These industrial supply disruptions created a feedback loop that made the bank's short positions increasingly untenable, regardless of margin requirements or other financial market interventions. Every production delay or supply shortage announcement reinforced the narrative that silver was becoming genuinely scarce rather than merely expensive, attracting additional buying interest from investors who understood the implications of industrial shortages for long-term price trends. I watched the banks attempt increasingly desperate measures as their kill switch strategy collapsed in real time. Anonymous sources leaked stories to financial media suggesting that silver buying was being driven by speculative mania and bubble psychology, apparently hoping that negative coverage would discourage additional investment. The stories gained no traction because the obvious industrial demand provided a rational basis for higher prices that made bubble arguments implausible. Regulatory officials hinted at additional margin increases and position limits, threats that would have sent silver crashing in previous decades, but now seemed like empty gestures from institutions that had lost credibility. The market had called their bluff and discovered that behind the regulatory intimidation was nothing but desperation from banks whose short positions were generating losses that threatened quarterly earnings. The really dangerous moment came during the Friday afternoon close, when I realized the banks were trapped between their catastrophically failed manipulation strategy and an approaching weekend that could trigger an Asian gap higher that would make their situation not just embarrassing, but potentially catastrophic for their quarterly earnings and regulatory standing. Silver was closing Friday at $64.15, down only 30 cents from pre-margin hike levels, despite the most aggressive regulatory intervention in decades, a performance that demonstrated complete market immunity to their strongest weapon. If silver gapped significantly higher on Sunday evening when Asian markets opened for the new trading week, it would send an unmistakable signal to global financial markets that Western regulatory control over precious metals pricing had been permanently broken. The traditional power structure that allowed Western banks to manipulate commodity prices through regulatory capture would be exposed as impotent against the combination of physical scarcity and strategic industrial demand. The banks desperately needed silver to close Friday looking weak and defeated, showing clear technical damage from their margin intervention. They needed charts that displayed obvious selling pressure and momentum breakdown, evidence that their regulatory nuclear weapon still possessed the power to break rallies and force speculative capitulation. Instead, they were staring at price action that looked defiant and resilient, suggesting that their intervention had failed to achieve any meaningful impact. The mathematics of weekend gap risk were working against them in ways that made traditional market manipulation strategies completely ineffective. Asian physical silver markets operated during Western weekend hours, allowing industrial buyers in China, Japan, and South Korea to trade physical metal while American futures exchanges remained closed. If physical demand continued accelerating while Western paper markets were offline, Asian buyers could drive spot prices significantly higher before Western traders had any opportunity to respond. Shanghai Gold Exchange trading typically began Sunday evening at 9 p.m. local time, which corresponded to 9 a.m. Eastern Standard Time on Sunday in New York. During this gap period, any major industrial purchases or government buying programs could create price disconnections that would force painful adjustments when Western markets reopened Monday morning. The banks were facing a nightmare scenario where their failed margin manipulation had actually attracted additional Asian buying interest rather than discouraging it. Chinese industrial buyers, Korean semiconductor manufacturers, and Japanese electronics companies were all interpreting the margin hike as confirmation that Western silver supplies were becoming critically constrained, motivating them to accelerate their purchasing programs rather than delay them. If silver opened Monday morning at levels significantly above Friday's close, it would represent more than just financial losses for the bank's short positions. It would constitute visible proof that their era of market control was ending, that physical reality was reasserting dominance over financial engineering, and that their regulatory weapons had been rendered obsolete by forces they could no longer influence or understand. I realized that December 12th, 2025 would be remembered as the day the banking establishment discovered that their traditional tools for controlling commodity prices had been rendered obsolete by the transformation from speculative to strategic demand. The kill switch had been activated with maximum force, but the machine it was supposed to shut down had evolved beyond its reach. The margin nuclear weapon had failed not because it was poorly executed, but because the market it was designed to control no longer existed. Silver had transitioned from a financial instrument traded by speculators into a strategic material hoarded by governments and industrial giants, and no amount of regulatory manipulation could force Samsung to stop needing silver for battery production or China to abandon monetary diversification strategies. The banks were learning what happens when mathematical models based on historical patterns encounter physical reality constraints that don't respond to financial engineering. They could change margin requirements, but they couldn't change the fact that global silver production was insufficient to meet industrial demand growth. They could manipulate paper markets, but they couldn't print physical silver or negotiate with geological scarcity. As Friday trading ended and the weekend began, I understood that the failed kill switch represented more than just a tactical defeat for the banks. It marked the end of an era when financial institutions could control commodity prices through regulatory capture and market manipulation. The physical world had reasserted its dominance over the paper world, and the transition was irreversible. The banks would try other strategies, coordinated selling, media campaigns, regulatory pressure, but they had already revealed their desperation by activating the nuclear option and watching it fail. The market had tested their ultimate weapon and found it powerless against the combination of supply scarcity and strategic demand that was driving silver prices beyond their ability to control. Saturday morning brought definitive confirmation that the kill switch failure had permanently altered the balance of power in precious metals markets in ways that would reshape global commodity trading for decades to come. Silver was trading at substantial premiums to Western spot prices on Asian physical markets, suggesting that the regulatory manipulation had created profitable arbitrage opportunities rather than effective price suppression. Industrial buyers across China, Japan, and South Korea were treating the margin hike-induced weakness as an unexpected buying opportunity, accelerating their purchasing programs rather than delaying them as the banks had hoped. The banks had changed the rules to stop us, but discovered that we had fundamentally changed the game beyond their ability to influence or control. Their kill switch had failed because the machine they were trying to shut down was powered by physics rather than psychology, by geological scarcity rather than speculative sentiment, by industrial necessity rather than financial greed. And those natural forces didn't respond to margin requirements, regulatory intimidation, or bureaucratic manipulation. The silver market of December 2025 was fundamentally and irreversibly different from the silver market of 2011, operating according to industrial logic and supply constraints rather than financial sentiment and speculative psychology. The banks were fighting the last war with weapons designed for a battlefield that no longer existed, and their defeat was as inevitable as it was complete and humiliating. They had played their strongest card and lost decisively. What came next would be determined by the immutable laws of supply and demand rather than the increasingly irrelevant whims of financial manipulation and regulatory capture. The kill switch had failed catastrophically, and there was no backup plan for institutions whose entire strategy had depended on their ability to control markets through political influence and bureaucratic intervention. The weekend would ultimately tell us whether this failure represented a temporary setback or permanent transformation in global power structures. But as I watched silver hold its gains despite the most aggressive margin intervention in modern memory, I suspected the banks had just discovered that their era of market control was ending permanently. The physical world was reclaiming dominance over the paper world, and that fundamental transition was irreversible regardless of what desperate measures they might attempt next.